So, you're ready to buy a house. You prepared your finances, you've saved up for a down payment, you've budgeted the cost and curveballs of home ownership. Now you're on Zillow night and day searching for the right home for you, and maybe even starting to tour a few finalists. This is so exciting. All that's left is getting a mortgage. But where do you start? If this intimidates you, you're not alone. Luckily, you're here with us today for Ask Zillow Anything presented by Betterment, so that you can learn how to approach this very important and often confusing step toward homeownership. If you're confused about mortgages or where to start with the lender, you're not alone. As I said, it can feel pretty daunting to many of us. And that feeling is no surprise for Zillow Premier Agent partners who often find themselves juggling the complexities of mortgages along with their clients.
My name is Micah Harper. I'm the broker for Exquisite Properties in San Antonio. So I had a client who forgot to mention that they already owned a house to their lender. And so we found that out just before closing, and the lender had to, of course, adjust their debt-to-income ratios and their expenses to make sure they could still afford both houses. And they had to rush and get the house leased. They had 24 hours to get it leased or we weren't going to close, and they weren't going to be able to close, but they did it. And so we were able to get it closed.
Oof, that's a hard story to listen to, but it's a good lesson to learn. It seems like there's a ton to learn on this topic. Luckily, we've got a great expert on hand from Zillow Home Loans, Zillow's affiliate mortgage lender. Hi, Cece, can you introduce yourself?
Hi, Julia. I'm Cece Wynn. I'm a mortgage origination manager here at Zillow Home Loans.
Let's start with the big picture. What is a mortgage?
Sure. A mortgage is a specific type of loan related to a purchase of real estate. When you're looking to purchase a home and you don't have the cash to purchase it outright, you're going to want to talk to a lender in order to get a mortgage to cover the difference in what you pay up front, which is your down payment, and the total sales price of the home. This mortgage loan will be secured by the property you are looking to purchase.
What is a conventional loan?
So first off, you'll hear about a lot of different types of mortgages out there. The first one will be conventional. So it comes in two types, conforming and non-conforming. Conforming, which has a maximum loan amount that's set forth by Fannie Mae and Freddie Mac, which are the entities that provide the backing for these conforming loans. Another type you'll hear will be non-conforming loans. They're less standardized and vary widely by lender to lender.
Cece, what is a FHA loan?
The other type you hear will be FHA loans. They allow for low down payment options, as low as 3.5%, lower credit score options than conventional loans, and they also have a maximum loan amount limit that varies from county to county.
Cece, can you tell us about a VA loan?
VA loans is insured by the Veterans Affairs. They're there for our service members who are eligible for the options of a 0% down. Other types you hear as well too, from these types of loans, you'll also have different types of loan terms. You'll have a fixed rate option, or you'll have adjustable rate mortgage option. A fixed rate option just means that the rate is fixed for the life of the loan.
So I've heard this term ARM. What does that mean?
The adjustable rate mortgages is a mortgage where you have an initial number of years that are fixed on that interest rate, and followed by a frequency of the interest rate can adjust after that fixed period. The first number that it shows will let you know how long that fixed period will be. And then the second number afterwards will let you know how often it's meant to adjust. For example, if you have a 5-6 ARM, this means that 5 years, your initial interest rate will be fixed. After that, the interest rate will adjust every 6 months. The most common fixed periods you'll see is 3, 5, 7, and 10 years. And 6 months is the most common adjustment period.
Okay, wow, lots of options. I'm going to need a little refresher on that. And I bet many of you are too. Zillow has a couple of great resources to go deeper on mortgages. The first is our home buying guide, which I've talked about in previous episodes. Seriously, guys, it has so much great info, so you definitely have to check it out. The second is Zillow's Mortgage Learning Center. This resource covers all of the types of mortgages Cece mentioned with more information, plus a handy glossary for all of these terms you only see when it comes time to get a loan. If you feel in over your head a little, that's okay. That's why we have professionals to help guide us. Another confusing layer to mortgages are all the acronyms. It's like alphabet soup. ARM, P&I, APR, LTV. Oof. Cece, can you talk us through some of the common acronyms buyers will hear when they're preparing to get a mortgage?
Julia, you're absolutely right. There are a ton of acronyms out there. It almost is its own language. So the first one you'll hear that's super common will be principal and interest. So principal is the amount of the mortgage that you'll have to pay back. Your monthly payment will include a portion of that principal, and every little bit as you're making those payments will help pay down the balance. Then there's also interest. Interest is also included that payment, and it starts to pay the bank their fees, their costs for what you borrowed. And principal and interest, when we talk about it together, it makes up your total loan payment. You might see this as PITI, which stands for principal, interest, taxes, and insurance. These are the 4 basic elements of a monthly mortgage payment.
Can you tell us what APR means?
Sure. So APR, that's another thing you'll hear quite a bit that pairs a lot with the interest rate. So the APR is going to take into the calculation of the interest rate, the lender fees that are associated with it, and any points that you have to pay for the rate that you choose. The biggest thing to keep in mind when you're out there shopping for rates or shopping who you want to go with your mortgage is to consider what the interest rate is and what the APR is. A good rule of thumb is the further they are apart, the more you'll know there might be some more lending fees and points.
Can you tell us about the acronym TIP?
Yeah, total interest percentage. This is something that comes up not as often, but it's still very, very good to know. But basically what it means is that it takes into account the interest that you've been paying over the life of the loan. So example, if you had a 30-year loan, the interest rate's at 5%, it will take into account the total amount that you'll pay over the life of those 30 years.
What is LTV?
What loan to value is, also known as LTV, this will be the loan amount that you choose to borrow versus the value of the home. That's what will make up your loan to value percentage. So for example, if you were looking to put 3% down on your new home, your loan to value of the home will be 97%.
What is PMI?
Sure. So private mortgage insurance, that's available for you. So the great news about private mortgage insurance, it allows for people to buy a home without having to put 20% down. So private mortgage insurance is available to you if you're looking to put less than that, whether you're putting 15, 10, 5, even 3% down. Private mortgage insurance will be included, whether you're paying it monthly or upfront, depending on the loan that you choose to get.
Whew, that was a lot of acronyms. If you ever find yourself forgetting what one of them means, we have a handy online glossary as part of our Mortgage Learning Center where you can remind yourself. But in terms of getting educated on the options specific to you, it's so important that you engage a lender early. A Zillow survey in 2021 found that many first-time buyers are worried about being judged or feel they have to understand everything before starting the conversation with lenders. But you don't. If you wait, you can face delays when you're ready to move forward if you don't have the right requirements for the loan you want to get. Let's hear from another Zillow Premier Agent partner.
My name is Becky Garcia, and I'm an agent with eXp Realty. I run a group called the Garcia Group, and we're out of Phoenix, Arizona, and we're a real estate company. So probably my most interesting mortgage origination story had to do when I was working with a first-time home buyer. We were able to find them the perfect home in just a few days from escrow. They called me excited about how they just bought all this furniture. They were going to be able to, furnish their home, and we're really excited about it. So once they told me that, got a little nervous because I knew that we were very close to their debt to income ratio. And so I was really worried they weren't going to any longer be able to qualify for their mortgage. So that ended up being the case. So they had just put all that furniture on layaway, had to go back to the store, beg the owner, who thankfully gave them a break and let them get out of their layaway contract, which then allowed them to purchase the home. But they were really close to owning a house full of furniture with no house.
Wow, whew. That seems like a really stressful situation. So for those who are going to start the process, what should they look for in a lender and how can you compare them?
When you are out there looking for your mortgage, you'll end up running into 2 different types of lenders. You'll have your mortgage lender or you'll have a mortgage broker. A mortgage lender is someone who works for a bank or a financial institution and they'll be originating a loan for you from beginning to finish. Mortgage brokers are going to be people who have access to multiple lenders, and in a way, they'll be acting as the middle person as they find you the best rate with the best program. You're not going to be working directly with them, but they'll be finding you the best option possible. A really great place to start is with a personal referral, someone that you trust. It really all depends on what's most important to you, what you want to look for, because the mortgage process or just buying a home is so complex. You want to find someone who's going to be an educator, an advisor, and an advocate for you.
Tell us some of the major differences between a national and a local lender.
So the differences between a national and a local lender really will be national lenders will have the ability to go across the US. They will know all types of markets, and so their knowledge between a competitive market, a slower market, they'll have an expansion of the knowledge in different areas. A local lender will be more specific to your hometown, and they'll be more specialized in what's in your backyard.
What are some good questions to ask lenders?
So some great questions to start with is, what type of programs do you have available for me? Do I have to put 3% down, or are there options for low down or no down payments? And also, it's really important just to let that person know that this is your first time. You are a first-time home buyer, and that is there any other questions you should ask?
Cece, that's some really great info. Finding the right lender for you is so important. And just to call out, you can actually search for lenders through Zillow's lender directory. Just go to zillow.com/mortgages and select lender directory. We talked about most of what you need to prepare for a conversation with a lender in our very first episode this series. As a reminder, here are some of the things you'll want to be sure to have on hand, or at least be ready to gather when kicking off those conversations. But there are actually even more steps you can take beyond pre-approval, including being pre-qualified and pre-underwritten. I'll let Cece explain.
When looking to get pre-qualified, this is sometimes the first step you can take. This is the first question that you have is, how much can I afford? You'll give some information about how much you make, maybe some of the debts that you have out there, and then they'll be able to let you know what you could or can buy. The next stage from there would be getting pre-approved. So pre-approved really means that you are giving and we're verifying income, assets, and your credit. The steps in the process would be taking an application, verifying your income, qualifying or verifying your down payment with bank statements. From there, your lender will take it back, do a file review, and let you know what you can buy and deliver you a pre-approval letter. This letter you can give to the agent that you're working with, so when you do submit offers, that letter is there for you to show that you have proof of financial backing. So what pre-underwritten pre-approval will be, another level past the pre-approval. A pre-approval is the best to your loan officer's knowledge. When it gets underwritten, your file goes to an underwriter. They are able to verify your income, assets, and credit, and they'll be able to say, yes, you have been reviewed. I'm an underwriter that says that you have financial backing, and that sometimes is a letter that you can use to give to your agent to be a better and competitive offer on the table.
Okay, I see. Thanks for clearing that up.
Julie, it was awesome being here. Thank you so much for having me. It's always a pleasure.
A big thank you to Cece and our Premier Agent partners for sharing their expertise and experiences with us. Remember, you can always head to our online resources, Zillow's Home Buying Guide and the Mortgage Learning Center, to dive deeper on anything we've covered. And if you aren't finding what you need there, drop us a line on social. In our next episode, we'll cover what you can do once you already own your home but find yourself needing to make some changes. Do you renovate or relocate? Thanks for tuning in, and see you next time.